The Big Russian. Give it up for Mike Zlotnick.
Thank you.
Oh, yeah, the rug.
Well, before they find the presentation, I'll take a minute or two and talk a little bit about.
Yeah, I just do real estate full time, so I do a lot of flips and some
that the
buy and
clicker?
holds. Yeah, we'll definitely connect. Let's have
So-
some lunch.
It's a privilege to be here. I met David, the Collective Genius Mastermind, I can't remember, 4.5, 5 years ago. And it's been truly a blessing to know him. And again, you've heard all the wonderful things. You're part of the group. And I was here, I don't know, maybe 3 years ago. And then I stopped coming, and then he asked me to come in May again, and I'm here again, and I feel privileged to be here, so I appreciate all the folks here and appreciate the opportunity to be here. So before they find the presentation, let me chat a little bit about what the presentation is about and how I kind of put it together. There we go. So I'm a fund manager. I spent 15 years actually in software development. My career was information technology and software development from 95 to 2009. But I spent many years with interest to buy real estate in 2000. In the year 2000, I bought my first apartment, and I started buying more apartments and houses ever since. And I was an investor from 2000 till 2009, a truly passive investor. And then, 2009, I was a corporate executive and exhausted working, just like you are professionals working in your own office. I was exhausted working in the corporate world. It's not fun. You get phone calls. I don't know if dentists get a phone call in the middle of the night, but in software you do. When the system goes down and you're responsible, you have a team. So to make long story short, I decided I'm done. And my good friend started our first fund in 2008. He called me and says, won't you come and run it? I said, what do I know about fund running? He says, it doesn't matter. You know real estate. You're smart. You'll figure it out. So from 2009 until now, I've been a fund manager running that fund, and then 3 other funds since. And we've done a lot of deals in the past. At this point, I think we've done about $150 to $200 million in loans, well over 1,000 deals. And it's been a fun journey. I truly found a passion in doing real estate. I hope you find a passion. I hope you find love with real estate. It's a great asset class, beats the heck out of stock market and many other asset classes. So let me jump into this. So this whole presentation is about real estate funds and comparison of real estate funds to individual deals. There are mutual funds, real estate investment trusts, publicly traded, and you can invest in those. Or you could go the route of small fund consideration. And in April, I was at a conference ran by our fund administrator where they had basically a pitch fest of 20 funds and syndicated equity deals. And I was sitting there taking notes and thinking about it and kind of analyzing in my head. I'm a mathematician by education. And I really went through that and said, this is all interesting. I have always wonderful notes. And a lot of it is my own kind of experience listening to other folks. So I had 4 pages worth of notes on my own writing. And then I worked with Corey Boatwright. David also works with Corey Boatwright. Corey is a great real estate investor, and he's a good friend. And Corey said, let's have you write a book. What do you mean write a book? So was it, I need to write 100 pages? He's like, no. You have 4 pages, that's enough. I said, what are you talking about? He says, let's just talk through this. And we did a sort of a podcast interview, and he took the notes and transcribed it, and I have a book. It's sitting on the table over there. So the book is going to cover a lot of these subjects, and it's all about the questions you should ask before investing in a real estate fund. It asks very simple fundamental questions, and that's what my presentation is about. You could apply the same concepts to any real estate investment fund, big or small. So let me jump. Now it's a disclosure. This is for educational purposes. Okay, so those of you who have thought about investing, you've heard of these guaranteed, safe, secure investments. The moment you hear those words, who comes to mind? Bernie Madoff. there are really only one class of things that is guaranteed here. It's the US government bonds, treasuries. That's really a guaranteed investment. That you could probably have 100% certainty it's a real thing. Everything else is speculative, there's a risk involved. Even guaranteed and insured bonds, during the days of the crash, the whole thing can collapse. So just be aware that somebody tells you this, stay out. Most likely it's Bernie's type of deal. So the real safety of the investment comes from three things. Number one is fund strategy. Number two, fund diversification. And number three is project underwriting or due diligence. So if you think about these things, they enable the fund manager to make prudent investments. So when you look into a fund, the safety will come from those things. So let me just cover very briefly on a couple of key underlying things to the fund strategy. Number one is asset type. So the fund can invest into different asset types. In real estate, what are the fund asset types? It could be residential real estate, 1 to 4 units, houses, or duplex, triplex, quad. Or it could be multifamily, could be commercial, strip mall, could be office building. So investments into different asset classes have different degree of risk. The other really important element is use of leverage. So this could sink you like you won't believe it and make you very successful like you won't believe it. It'll magnify return, crash returns. So I'll give you two very simple examples. During the days of the bust, there were a lot of publicly traded leveraged mortgage pool funds, billion-dollar funds. And then they had leverage. Essentially, they made loans at 6% and borrowed money at 4% with humongous leverage like 90%. And I was investing into one of them. One day I was collecting 15% yield. Next day, the whole thing went poof. Same thing happened with the oil industry. When the oil was $100, $150 a barrel, these funds were paying remarkable returns. When the oil crashed at $40, I remember to the day, I bought it into my wife's IRA, a fund called VNR, that's the ticker. This thing was, I don't know, $20, it's now a couple of cents, it's in bankruptcy, it's gone, essentially. Why? Because of the leverage. So leverage works both ways. So when you look into a fund, find out what is the leverage on the asset level and on the fund level. If the average is anywhere higher than 2 to 1, which is essentially they borrow more than 2/3 of the money, it's probably already high risk. So this is the really important question, is to find out what leverage the fund has. And part of the strategy, what's the max leverage and what's the current leverage. The other key element is the cash flow. So there are funds that focus on appreciation. And there's a lot of upside, and there are ground-up construction deals, there are redevelopment deals, and they're absolutely fine, but they have no cash flow. So depending on your objectives, depending on the market conditions, if you focus on cash flow, in many ways you can't lose. Appreciation, you can build a condo building, it doesn't sell. But if you have a great asset with strong cash flow, even with leverage, you could sustain downturn. So these are key elements. Fund diversification. So those of you who have heard, somebody was speaking earlier today, they had a Warren Buffett saying that the fund diversification is for those who don't have enough experience to make their own decisions. It's both true and false. Warren Buffett is the ultimate diversifier. His whole company is one massive diversification pool, if you think about it. So diversification can never be wrong. If you diversify, you don't put all your eggs in the same basket. You can, in the worst case scenario, just make a little less return. But in the best case scenario, something will sink and something will be hugely successful. So it'll balance out. Diversification can be on a fund level, when we make decisions what to invest in, we decide between asset classes, we decide between the geographic regions, we decide between type of project sponsors or borrowers. So you can diversify in many different ways. One really simple question on diversification is, what's your average deal size as a percentage of the total invested capital? So if somebody has 20% in a single deal, that's too much. If somebody has an average of 1.5%, it's probably fine. Does that make sense? Okay, let me keep running forward. So project underwriting is a speech of its own. I want to just cover a couple of elements. A speaker before me talked about due diligence. This is critically important that you do due diligence in every deal. You underwrite the borrower if it's a loan, or you underwrite a project sponsor if it's an equity deal. So we have some investments in syndicated equity deals. We know who is the project sponsor, the integrity, their track record. So we'll talk about project underwriting. I think I have it covered a little bit later, but that's another key element. Let me kind of keep moving forward. Okay, the next question after the safety of the money is how easy to get the money out. Really important question, probably should be number 2 question. And most of the funds have a concept of a lock-in period. So I wanted to make sure you understand what it is. Typically, when you invest in a fund, you can't take the money out unless you have an emergency. Many funds do allow for emergency withdrawal, and there could be penalties, but at least you should be aware. Most of our funds have a 2-year lock-in, so if you're planning to need the money back in 6 months, that's not the place for you. So the other really important element to this is, does the fund financial model and the asset model have, and strategy have a good liquidity? So I'll give you an example. The fund could be making long-term investments, multi-year developments, and all the money could be tied up in projects that they can't get any money out of it. So investing in projects like this and having no idea how they can get liquidity, you're going to get stuck. It's that simple. So the question is, does the fund have good liquidity? I'll give you an example. We take half of the money in our lead fund and we put it in long-term deals, and half the money we put in the short-term bridge loans for fix and flip projects. These rotate fast and we maintain high liquidity. The long-term deals have much worse liquidity. So these type of questions are really important to understand if you're trying to make a decision whether you're going to be able to get your money out. And then the other interesting question is the fund open-ended or closed-ended. So what that means is a closed-ended fund typically has a certain amount of time where they keep raising capital and they close, and then they make the investments. And the whole portfolio essentially lives a certain amount of time, and then they wind investments down and repay investors. So an open-ended fund continuously raising capital and has high liquidity because the fresh investors can always take out the older ones. Does that make sense? So I hope that that's pretty clear. So that's a fund liquidity. Return on investment. So the reason you're investing, you're trying to get a return. So return could be a really simple number, or it could be a complicated figure. But the components of the return, number 1 is the cash flow. So every investment generates cash flow or no cash flow. So the question for you to ask, how much of the return comes in the form of a cash flow, and how much of the return comes in the form of the appreciation? Typically, most funds will have 2 figures. 1 is the annual cash flow, and 2, total return. So total return could be 13%, while the cash flow could be 9%. The remaining 4% comes as an appreciation when the fund sells assets or the share price appreciates. Does that make sense? So cash flow is typically composed of, I hope it's not too technical. So many funds have a preferred return. So preferred return is a concept where investors get paid first ahead of the fund manager, in essence. So preferred return is sort of your floor to the investment. And knowing what's a preferred return is important. It means that that's not a guaranteed return, but that is a preferential return. So if a fund generates 6% return, and then the preferred return is 7%, that the entire return has to go to the investors. So the cash flow typically comes as a formula. There's a preferred return, and then this fancy-looking term, EDC. It stands for excess distributable cash. What it means is if the fund met the preferred return, it has more cash to distribute, and that's what it is. So typically also the fund has distribution in the form of quarterly or monthly payments. Let me keep running through because I'm running a little slow. So preferred return example here is 7%, and then there is a split. That EDC is a split, essentially, excess distributable cash, and typically it's split between the fund investors and then the manager. So it's a performance split. So the manager gets paid in the form of that little upside, the 20% share above, once the preferred return is met. So if the fund generated, for the sake of the argument, 17%, the first 7 went to investors. There's 10 more to split. It gets split based on the formula, depending on what it is. And then there's a target return. So most of the funds, they have financial models, and then they provide this estimate of what they think the return is going to be. It always should be a range. If it's a fixed number, it's really hard to be exact. So a range is probably an accurate way to estimate what the number should be. Well, it's a little bit about the management team experience. That's the next question is, when you're making a decision to invest into a fund, you should definitely do a little due diligence on who are the managers. You could even do a background search. If they have criminal records, stay out. But the experience is pretty important. So it's typically, you can ask the questions, how much money you manage, how many deals you've done, what's total deal volume. Those type of questions help you get a little bit of understanding what the fund managers have done and what their track record is. The other important question is historic returns. And pay close attention to the difference between average returns and recent returns, because market conditions change. So there are funds that have been around for a long time. They have great average returns, but recent returns have been sliding down. And it could be not a problem of the fund. It could be a problem of the market conditions. So I'll give you an example. We do hard money loans, and our returns used to be higher, and now they're lower because of what's going on in the industry. It's called yield compression. It's happening everywhere. But the trend is still there. You should still definitely look at the trend, and trend is your friend. It doesn't mean that it's not going to get better or worse, but it's really important. Okay, so the next section I wanted to chat about is you have a choice. When you make investments, you can go invest into a fund, or you can invest into individual deals. And the anti-Wall Street philosophy talks about don't give the money to some strange fund because you don't know what they're going to do with it. And there's some truth to this. So when you do individual deals, you have control, and you are an active investor to a degree. You can still be mostly passive. If you're lending money on a deal, you're mostly passive. But you should still be able to look at the deal and say, does the deal look right to me? Does it look like it has the right risk characteristics? So involvement is one of the big differences. The other one is liability. Most of the times when you're making a loan, you're never liable. Most of the states and jurisdiction system is such that it's very hard for you to get sued as a lender. But if you're an equity owner of a property or a commercial building or multifamily, you can get sued. So when you invest in a fund, you have generally no liability. All the mortgage documents, everything else that gets signed for a fund purchase gets signed by a fund manager, and there's never a personal guarantee that you signed personally if you're a fund investor. If you do an individual deal, you buy a building, you're signing a personal guarantee, and there's liability associated with ownership of the property, and there's liability associated with a bank loan that you've borrowed the money for a property. If something goes haywire, you can be held responsible. The other massive difference is diversification. We talked about it when you invest into any individual deal. It's a single house. You buy the house with a mortgage, you buy it with cash, or you make a loan on a property. It's a single asset, single property. If anything goes wrong with that property, we've had once a property that fell into a sinkhole in Florida. The sinkhole opened up, and then the property value went. So it happens, and when you invest in a single asset, you have that risk. There's a theoretically some catastrophic loss of capital due to a situation like this. With a fund investment, you have diversification of a lot of assets. And then the other interesting question is liquidity, which is really something that you got to think about. When you're making investments, you're investing your IRA money, you don't need a lot of liquidity today, that's fine. But there are plenty of situations where you're investing in an individual deal and you need liquidity. and you got to really think about, what if this property gets stuck, I can't get the money out? It has happened to people many times, even when you're making a loan or you're buying a property. Just be aware of the liquidity. So if you need the money out fast, some people think of it this way. Fund actually does have better liquidity in general than an individual deal. If the fund is open-ended, it has decent financial model that maintains liquidity. So those are the general differences between individual fund investment and individual investment and fund. So there's a lot more. You saw a couple of questions there, and there's a bunch more questions. I actually have that in a short book that's sitting on the table over there right next to Robert. And feel free to read. I'm just giving you a little warning about the book. It's a transcription of an interview. There's a little bit of, there could be minor grammatic errors and so on. So just, you can catch a couple of errors. It literally had to get shipped at the last minute. It was a little bit in a rush. So the content, I think, is really good. You're going to enjoy it. But if you catch some spelling things and little, here and there, give me a little break. Please give me an element of a doubt. I think that's about it. Yeah, that's it. Thank you.
Thank you, sir. I remember, Mike, I think I remember the first time, at least that I met you at one of the Freedom Founders events, and you talked about some of these things, and a lot of it was going way over my head, but hearing it again and again a few other times, and being at a roundtable or two has really made a big difference. There's a whole other world out there beyond individual deals, what you do with funds and what Bill Fairman and Wendy Sweet are doing with funds, and it's a great place to start, I feel like, when you're just getting into real estate.
Yeah, thank you, Robert.
Yeah.
I wanted to say this. So if some of this stuff was not 100% obvious, and I apologize for running the complexity, I'm a mathematician, but I could tell you, just talk to me. I'm more than happy to break it down. And there's a whole world of complexity with the funds, but in many ways it's really simple. So I'm here. Please ask questions. Happy to. And by the way, if you have a deal coming up, I'll make this offer. I really enjoy analyzing deals. This is what I do for a living. If you have a deal and you want feedback, I'm more than happy. I'm never going to charge you $1 to give you feedback on a deal. I'll analyze at least the mechanics of a deal, the math, the finance side, and I'll tell you right away whether the numbers look good. I can't tell you if the house looks good. You got to go to the property, like the speaker before me was talking, check if there's termite damage and everything else. But if the numbers, I can definitely help you with. So.
Wow, that is an offer right there. Thank you, Mike. Talk about getting the right people on your investing team. Someone you can just kick a deal out to and say, can you help me along this due diligence here, who's been doing it for decades. Wow. Thank you, Mike. Brilliant. Okay, guys, we're going to turn you loose for a break. Everybody's coming back in here for 5:20. 5:20, last session of the day. We're going to tag a couple of things on the blueprint. We've got some recognition for some of the FIT team MVPs, so you don't want to miss that. We'll have, coming up, we're going to talk to you about what you should expect first thing tomorrow morning. So just this was a little bit of taste of what most of tomorrow is going to be, as I said. So we'll have a few other different ways of looking at real estate that we'll be talking about. Here, a presentation on the state of the market. Mike talked a little bit about market condition, right? So we'll have a presentation on where the market is today and what that means for investors. It's going to be a lot of fun. We're going to do roundtables again. You'll have an opportunity to get those passes and seek out the advisors that you want to sit with. So tomorrow's going to be great, but we have one more session. You're coming back at 5:20. This one's going to be a pretty short session relatively, and then we'll turn you all loose. So thanks so much for being in this room with me. We'll be all back together again, open seating at 5:20. Have a good break.